Could you kindly introduce yourself and tell us a bit about what you do at First Sentier?
Yeah, so my name's Michael Joukhador, and I'm a senior portfolio manager in the Australian small and mid-cap team. And I work with Dawn Cornelius, managing three strategies, one of them being a mid-cap strategy, so investing effectively outside the ASX top 50,
Mhm.
a small cap strategy, managing an index, effectively that index being the small cap index, and then managing a long short strategy as well. So it's a 130-30 fund. And that fund is very effectively replicates the kind of process and philosophy of the small cap fund, and in fact, in terms of process and philosophy, the mid cap fund as well, in fact, but it allows us to also short some of the companies where we see significant downside risk, or even just
Mm,
some downside risk, but not a lot of upside risk, given the very poor business model with poor financials.
perfect. I want to ask you a personal question. So, what is the first thing you've ever invested in?
Yeah, look, it's a really good question because I think it does give you some insight in terms of the way I think probably. And actually,
Hmm.
the answer is a house in Sydney.
Yes.
But
Yeah.
the reason why I invested in that house actually was because I identified this was over 10 to 15, probably 15 years ago. But the government came out with the granny flat laws in terms of they changed the regulation to allow you to develop a granny flat on a
Yes.
block outside, larger than 460 square meters.
Mm,
And so I took that opportunity to buy a block. And of course, Sydney prices, property prices have always been, expensive. However, I realized even though the return on the original investment was quite low, you can actually get, effectively 15 to 20% return on the granny flat.
yeah.
And so for me, that I recognize that I can get a 20%, free cash flow yield on the $150,000 granny flat I could invest at the
Mm,
back of that property. And so that was the first thing I invested in terms of significant investment. And then on the markets, I think the answer is actually Coventry Group, which is not a great company, but having read in my early years, obviously the Warren Buffett books and, the Intelligent
yes.
Investor, thinking
Yeah.
about value. At the time, it was, effectively the GFC. I was able to invest in that below. In fact, I think I had $100 million of cash and a market
Mm,
cap smaller than that. And so and it was profitable business. And so buying a profitable business with a pile of cash on the balance sheet and a market cap below that, and so a low risk opportunity effectively to invest in the market, giving me confidence in terms of that downside risk protection. And that was a very long time ago now. And that played out well because in the end, within a year, I think I got a special dividend bigger than my original
nice.
investment. But in saying that, had I invested it in realestate.com at the time, the returns would have been significantly larger. So sometimes it does pay off to actually invest in a high growth company instead.
Yeah. Yeah. It doesn't have to be just the small companies. Could you define what a small cap actually is?
Yeah, look, that's an interesting question because in terms of the way we frame it or the industry frame the small cap, it's anything really inside the small cap index, so outside
Yeah.
the top 100. However, there are stocks in that index, and I can give you like News Corp and TPG, and even Light and Wonder, for example, which is a recent entry onto the ASX. All of those companies are actually larger than many of the Australian top 100 companies.
Mm,
But because of free float reasons, they sit outside that top 100. But really, some of those companies are quite large. And so really, the definition is quite grey, really. What should be defined as a small cap?
yeah. So it's a range. What would the market cap be for those small cap stocks if there's a rough range?
Yeah,
Um,
so News Corp has a market cap larger than $10 billion,
yes.
as an
Yeah. Yeah. So
example.
quite large. Yeah.
Yeah, so quite large, and TPG similar, and all the way down to, in terms of our investment universe, in fact, our mandates normally specify larger than $50 million. And
Mm,
we don't have, given our size, we don't actually invest in anything even close
yes.
to being that small. However, there are companies that will, especially in our long short fund, will take a small position when they might be 100, 150 to 200 mil market cap.
Yeah.
And that will be a very small position while we kind of watch those companies develop into something hopefully more meaningful over time, and we can kind of go on the journey from effectively an embryonic stage business case to being a much larger company. And XDC is an example
Mm,
of a company, very early on in its journey, we're able to invest almost as a microcap before it even made, effectively headed, before it was even in the small cap index, but technically
mm,
it is a small microcap, and now it's the top 100.
yeah. So why might someone invest in the small caps rather than a mid or large cap?
But generally, and there's probably two answers. I think over the last 17 years, in terms of my career, historically, some of the great Australian effectively the future success stories were
Yep.
always found in small caps. And I can
Mm,
give you examples of Seek, REA, WiseTech, Altium, Car Sales, even James Hardy
mm,
would have been a small cap at one point, and Flight Centre, and a lot of companies that kind of migrated from being small caps and slowly built on their business models. And as they became more resilient and larger, effectively, you're getting the benefit of that as a small cap investor. And those opportunities were not there available to you as a large cap investor, which was
yep.
really dominated in terms of the index by the really large financials and the really big mining companies,
Yes. Yep.
being the big banks, BHP, Rio, Fortescue, and even Fortescue at the time actually has a really good example, was also a small cap. And so those opportunity sets have always been why small caps are interesting and what you're trying to identify when you're a small cap fund manager. However, what I would say is over the last year, 2 years, 3 years, and partly because of COVID, arguably, partly because of the choppy economic, global geopolitics that we're seeing, and also the softness in the economy and inflation, we haven't seen a lot of great new IPOs and the kind of opportunities for us. We can't identify 10 or 20 or 30 great small caps that may look like some of those more larger success stories that we've seen in the past. And that's why, in fact, we have actually got a mid-cap strategy that I would say right now, today, is probably actually more compelling in our small cap opportunity set. But that's
Yep.
something that changes. And so hopefully in the next year, in the next 2 years or 3 years, I will be hopefully be able to present some wonderful small cap opportunities that may, in fact, look like Altium or WiseTech or our realestate.com
Yes.
over the
Yep.
coming 3, 5, and 10 years. That's the whole idea of it.
So could you identify the underperformance in the last 3 years, and what can we expect from small caps in the future?
Yeah, well, look, what I would say there, and I think I probably just touched on it, investment set in terms of the opportunity set in that index has diminished in terms of the quality of that investment pool over the last 3 years. And I don't believe that
Mhm.
yet really to be a structural problem. I just think on the back of the issues we had with, COVID and high inflation, and what we have seen is really a poor set of investment opportunities in that universe. And
Yep.
that's not the case all around. Like we can still find great companies, and some of them are just good small companies that we can invest in. But when you look at the relative opportunity set relative to mid caps in particular, and in the
Mm,
mid cap fund, where you will see realestate.com and car sales, and where you'll see effectively a portfolio of really strong businesses that are growing, and some of them already delivering really huge amounts of success globally, even
mm,
where you're still looking for that in small caps at the moment, in terms of there are pockets of opportunities,
yep.
but the opportunity set and the quality. So when you think about a portfolio, what you want, the great management team, great companies, sustainable competitive advantage, wonderful moats, effectively businesses with great great management teams,
Yep.
robust balance sheets, and growing, and that compound growth with the economies globally should
Yes.
deliver really strong returns. And that opportunity set at the moment is much better in the mid cap part of the market. In my opinion, that's what's driven the underperformance of small caps. It's actually the
Mm,
universe, the set of options in terms of the opportunity set not being as resilient, not being as robust. And hopefully that will change. That is just as we say, as we speak today, looking back over the last 1, 2, and 3 years.
okay. So is there a greater need for diversification when investing in small caps? And how do you approach the risk management with these investments?
Yeah, look, I think we've always, so from the day I joined the team, diversification was important.
Mhm.
And that's because in small caps, really, often you're investing in single industry companies
Yep.
with a very lean management structure. And often these companies need capital to grow.
Yes.
And for those reasons, it's important to, in effect, have a portfolio that is able to effectively have resilience at times when pockets of that portfolio are mis-executing. And
Yep.
sometimes it's no fault of the management team. It's a regulatory change or a structural change in an industry. And
Mm,
you really want to be able to protect the portfolio through all of those cycles, being maybe regulatory cycles, but even economic cycles, inflationary cycles, or geopolitical cycles. And so it is important to have diversification, but
mm,
also it actually creates a more resilient risk reward effectively mechanism for clients, because
yes.
there are some things you don't want to diversify away. You don't want to diversify away from wonderful, great management teams, for example,
Mm,
and great companies. And so what you want really, the portfolio that's diversified across industry and exposure. And so
yep.
But really, some things you want to be consistent. Great management team, great companies, great
Mm,
resilient cash flow, fantastic moats, and really then a portfolio. So, for example, really wonderful gold exposure is what you want in your fund. Low cost, long life assets in
mm,
wonderful jurisdictions, managed by great management teams behind them. And at the same time, you want exposure to great financials if you can find them, and great industrial companies, building material companies. If you can get diversified exposure to the Australian economy and even energy companies. So whatever is happening globally, whatever is happening through the cycle, there are always pockets of opportunities in your fund, and you're not
mm,
there trying to pick, effectively from a macro sense, which thematic is going to work, because you actually have exposure to all of those aspects. So whenever something's not working, there is another pocket of the portfolio that's working, and that's because you've got effectively great companies, great businesses, great assets in the portfolio, and some of those will be doing really well in any given year.
mm.